We didn't have inflation in financial crisis time. We didn't have inflation during the pandemic. Nobody's dealt with this type of inflation before and trying to make ends meet. That's why they're all pissed off. I can just see the surveyors calling up people and it's like, hey, Adam, I'm with the University of Michigan. How you feeling about the economy? Hey, F you.
Right.
You know?
Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back for another weekly market recap with my good friend Lance Roberts after a heck of a week. How you doing, Lance?
I'm actually doing okay. It's been an interesting week, kind of really across the board, but it's kind of interesting to see where we are because now we're talking, about this inflationary number that came out today. Of course, that spooked the markets because potentially more Fed rate hikes. But again, and we'll talk more about this today, we're still seeing the peak of inflation. And no, it doesn't look that way right now, but we're still seeing all the indications that we're probably seeing the peak of inflation occur as we speak.
All right, all great points, Lance. And I want to dig into the demand destruction that you were talking about there. Lots of evidence there that indeed is coming. I do, though, want to very quickly just focus on the data that you mentioned. This morning, the Bureau of Labor Statistics released the latest consumer price index for May, and it went up to 8.5 something, which is rounded up to 8.6. So that actually does make it the highest in the series since the beginning of last year. I think it's the highest in the past 41 years, since 1981, they're saying. So real quick, you and I have talked on this program for the past couple months that we think that the CPI is peaking out likely and likely to come down as the year progresses. That's for a variety of reasons, including the demand destruction we're about to talk about, but also just the way in which the CPI is calculated. The comparison to last year gets harder the further we go into 2022 because inflation was rising throughout last year. But I do just want to note that we sort of stuck our necks out and said we think that April was the high. Well, it turns out it wasn't, or sorry, that March was the high. Turns out it looks like it wasn't. There's a new high, but it's just by a little bit, largely driven by what's happening right now with oil prices. Anyways, long story short, if we don't call it exactly right, we obviously will let you folks know. But also, and it's worth maybe talking about here for a quick second, Lance, it's not that much higher. I mean, we're talking about 8.5 low to 8.5 high. And, I think you mentioned this before we started recording here that, peaks don't necessarily happen all at once. You get a little bit of chop at the top. So, I think to the spirit of what we're saying, jury's still out.
Well, and it's interesting because everybody's pointing at oil prices like, well, we have inflation because of oil prices. Actually, when you're talking about CPI, it's really not oil prices. Energy as a function of the CPI calculation is a very small percentage of CPI. What's really drives CPI is food, which makes up about 16% of the index, and homeowners equivalent rent, which is housing. That's over 40% of the index calculation. So it's, those two components are so large, they make up more than half of the CPI calculation. And interestingly enough, what's happening, of course, is with housing, that housing data that is used in the CPI calculation is on a lag. And if we take a look at what's going on, kind of boots on the ground, real time housing data, the number of showings that Redfin calculates, the number of mortgage application, the number of homeowners that are lowering the selling prices on their houses, et cetera. That's all telling us that there's already a peak in what's happening in real estate. And that's going to feed through in the next month or two. We'll start to see that show up in the housing data. So oil and gas prices can go up and you still see inflation come down because of just the magnitude of housing and food relative to the overall index. I calculate every time we have this, kind of run through inflation and we have these reports, always go back and I calculate the core CPI, which core CPI was in line with estimates. It was the headline CPI that was above. And, but also calculated healthcare and housing. And the reason I strip out healthcare and housing is as we talked about before here on the show, is that those costs are mostly fixed for most people, right? You don't go out and buy a house every month. You don't go out and buy an apartment every month, right? Our mortgage is fixed, our rent is fixed on a contractual basis for at least 12 months. If I'm renting an apartment, I'm renting it for 9 or 12 months. So I've got a fixed rent for at least that period of time. Healthcare, a lot of people, we get it through either the government healthcare program or we get it through our employer. That cost is also pretty fixed relative to what we spend out. Depends on how often we get sick and that type of stuff. But those costs are fairly fixed. So if we strip those costs out, the actual inflation for homeowners, now this is, for the average American, the actual inflation for the average American, now this is where we see this demand destruction really going to start to show up. It's over 11.5% right now. And that is food and gas and oil and apparel and these type of things. That's what people pay for every week, every month, every quarter. And that's where they're seeing all those savings really being sapped out the back end. And again, this is going to lead to demand destruction as we get further into the year.
Yeah, so a couple of things off of that. First off, for folks that want to deep dive into sort of how the housing market is sort of in a rapid cooling phase right now, way faster than folks were expecting. I just recorded a great discussion with housing analyst Nick Gurley. You can see that here. I'll put up a link to it right here. On the energy side of things, I just recorded a discussion with oil expert Art Berman that'll be coming on this channel next week. But we talked a lot about where oil prices are headed from here. And Art goes through a parade of data that I won't summarize here. You can watch the video when it comes out, but basically says the high likelihood from here is that we are going to see oil prices moderate later this year. And I won't get into all the exact reasons why, but basically, expert in the field says that, hey, just like what happens with a lot of other goods and services when inflation gets as high as it does now, it's kind of your motto there, Lance, that high prices fix high prices, right? People just start using less. You get the organic demand destruction that you're talking about. There's a couple other factors that may bring oil down as well. So to your point, the things that are propping up the CPI right now, we can already sort of see good empirically based arguments that those things are going to moderate going forward. Now, to be real clear, folks, neither Lance or I are saying that prices are going to come down tomorrow and everything's going to be a bargain. We're probably going to be living with elevated prices for a good long time, but the rate of increase of those prices is likely to start decreasing as we move on from here. That's actually called disinflation. So if you hear Lance and I talk about disinflation in future videos, that's really what we're going to be talking about here. So Lance, on the demand destruction side, we've really got two things going on here, and I just want to make sure people really understand this. We've got the organic demand destruction that I just mentioned, right? Which is that prices get so high that consumers say, you know what, I'm just not going to drive as much. I'm going to downshift my spending at the grocery store to cheaper products, right? Consumer prices get so high that consumer behavior changes. Maybe consumers can even just physically afford to spend less, right? Because they've just got less left over when their paycheck, gets cashed. So that's has a cyclical element to it, and we are probably at the part of the cycle where people are going to start tightening their pocketbooks. At the same time, though, you've got the Federal Reserve out there that is trying to dampen demand. So they are actually pursuing policies that are going to make you, the consumer, feel less wealthy, even more less wealthy than you feel right now, so that you constrain their spending and that companies don't make quite as much, and that the demand that's out there pushing prices up starts to moderate, right? So, when we talk about this demand destruction, I just want folks to know that it's not like we're kind of guessing that, maybe it may happen. We've got two really powerful forces that are working at this, and I don't see anything short of like true supply shortages that really could prevent that from happening over the next 6 to 12 months. Do you?
No, and it's absolutely right. And look, there's kind of several things that are going on. And as you were talking, I was, kind of these things were triggering in my head that we need to address. One is Janet Yellen's comments about inflation that she made earlier this week. how this woman is in charge of being Treasury Secretary and be so ignorant of economics is absolutely beyond me. Scary, by the way, but truly, truly astonishing how wrong she can be so often. But, we'll get into that here in a second. But to your point, as you talk about, rising inflation, the key factor we're talking about here, and you mentioned this, in passing, you mentioned wages. And that's such a key component of this entire discussion because wages are not keeping up with the rate of inflation. And if you look at what's happening with wage growth relative to what's going on with inflationary pressures in the economy, particularly with food and gas and things that people spend money on every week, there is a massive gap that's opening up between prices and wages. And that simply leads to the fact that, to your point, consumers have to start making a decision. Where do I spend money? Well, right now, they're all turning back to their credit cards. During 2020, 2021, we had a massive decrease in the amount of revolving credit because we sent money to households and people made some smart decisions. They go, oh, free money. I'm going to pay off that credit card that's been nagging at me for the last 20 years. I'm going to pay off that bill finally. And so we saw people do that. We saw revolving credit come down. Now, just in the last 2 months, and really it started a few months ago, but really accelerating these last 2 months, as inflation creeped up and as the last of that, essence of liquidity that was put into the system from unemployment benefits, expanded child tax credits, all this other stuff, as that finally ran out, people had to go back to those credit cards to make ends meet. We had a $55 billion increase in revolving credit in March, another 35 billion, in April, and another 35 billion in May. I mean, this has been a massive ramp up and people going back to credit cards. Now, the only reason, and I love these headlines that come out in the media, they go, well, look how strong the consumer is. They're just spending money like crazy. They're spending money they don't have. And that bill comes due. And the bad thing is, and this is kind of like we talk about unproductive spending for the government because we spend money on things like sending checks to households, which has absolutely no multiplier effect in the economy. And then once the money's spent, you're left with a debt you have to pay off. Well, this is the same thing that's happening with households. They're spending money on consumables. They're not spending money on things that will produce an income for them later. They're spending money on gas and food and charging on their credit card. So that $10 steak or whatever they bought on their credit card, they're paying interest on that meal over the next 20 years that they're going to pay off that credit debit. And that's going to be one of the things that nag on consumers going forward is even as we come out of this cycle, consumers are now going to be more indebted. They're going to have more debt to pay. And if interest rates keep going up, and as the Fed raises interest rates, those variable rates on credit cards are going to go up. That's even going to extract more capital from consumers that will have to be diverted to pay for debt rather than spending money in the economy to keep economic growth going. So from a demand destruction standpoint, you've just got a tremendous number of headwinds that are all kind of it's kind of like that movie, The Perfect Storm with George Clooney, where, you have all these big major storms all colliding into one supercell. That's what you've got going on here. You've got this rising inflationary pressure. Wages aren't keeping up. Now you've got the Fed extracting liquidity and raising rates. Just everywhere you turn, there's a storm that's coming and they're all about to collide at the same time. And how we get out of this without having a recession either later this year. And I see a lot of people right now are predicting, early to mid 2023. I don't know how we get, it's possible. I'm just not sure how we get there without having a recession sooner.
Without having one sooner, yeah. And we, as you and I have talked about, we could already be in one, right? And if you look at a lot of statistics, several of which you just mentioned, they're classic recessionary statistics, like when personal spending slows, but consumer debt balances increase. That's a clear sign right there. We already have negative Q1 GDP. Q2 GDP right now is being estimated at less than 1% and declining. So we could have back-to-back negative quarters, which would be a technical recession. But the spirit of what you're saying is like, you don't see how we can get there, make it to the end of the year without a recession arriving, like in full force, or at least, robust enough that we really notice it. I'm inclined to agree with you. I think taking the under bet on that is the wise choice. There was one storm cloud that you did not mention in your perfect storm, though, that is really worth talking about, which is layoffs, right? So, you were just saying, look, if we just continue at what we're at, where people are just putting more and more on their credit cards and getting more and more pinched, we still get to recession. But if people start losing their jobs again by the millions, that just compounds this thing to a whole new level, right? And I've talked a little bit on this program with you, I think before, Lance, on some of the layoff tracking that I've been doing. And, we are seeing a very notable uptick in layoffs already. And of course, there's a progression that you go through. Companies don't want to fire right away, right? So they do a job freeze, and then they start cutting hours and benefits, and maybe they fire the contractors, and only then do they lay off. But we're already seeing a number of companies laying off there. And I just recorded a video really all about this perfect storm on the consumer household side that's going to be launching early next week. So I'll save going through the litany of data on that for that video. But
real quick, I think that's an awesome point, because this is one reason the market sold off so hard on Thursday, was because that jobless claims number came in a lot higher than expected, and we actually broke above the 12-month moving average on jobless claims. Now that's here's the interesting thing about employment data is that record low unemployment or record low jobless claims are actually pre-recessionary. I know that's kind of hard to get your head around. Right. But it's when you get to record lows of anything or record highs of anything, it's a record for a reason.
There's only one way to go.
Yeah. That's exactly right. And you pretty much run out of people to hire. But, that jobless claims number is really interesting, to that point. And we are seeing, a lot of indicators. I've got a report coming out next week on the website at realinvestmentadvice.com talking about the National Federation of Independent Business. Now, this is a survey that doesn't get a lot of attention from the mainstream media. They kind of mention it when it comes out and they say, oh, the NFIB survey was 93. Well, that's down from 108, at the peak of the market back in 2020. And that's a recessionary number just in the overall index. But forget the index, dig down into the sub indexes of that report, and you start to see things like their economic outlook over the next 6 months is the lowest ever recorded. And this thing goes back to like the 1960s. They've never been this bearish on their outlook. Now, if I'm a small business owner and I'm super bearish on the outlook for the economy, am I going out to hire a bunch of people? Don't think so. Am I going to make a lot of CapEx investments? I don't think so. Am I going to build up a lot of inventory? I don't think so. And that's exactly what every one of those indicators are telling you. They are pulling back from all of that. And look, small businesses make up about 60 to 70% of all your businesses in the country. They're a massive component of the overall economy. So, neglect, and again, I go through everything in this report that we'll have out next week, but it goes through all this stuff. And it just tells you that there are problems coming sooner than later. And even the CEO survey that just came out has plunged into recessionary territory as well. So again, to your point, just, when it gets into the business hiring, part of the economy, it doesn't look good.
No, it doesn't. And so let's add to that another piece of data that came out today, right? Which was the latest University of Michigan consumer confidence numbers, which are down at 50.2, which is the lowest. It was described in the articles I read as a record low, but looking at the data, which I saw went back at least to the 80s, it's the lowest reading in the past 40 years, right, of the full data set that they were showing, right? So just think about that for a second. Consumer confidence is lower today than it was at the depth of the pandemic, when we were all thinking we were going to die and we put the entire world economy in lockdown, right? Yeah. Lower than the depths of the Great Recession, right? Lower than the depths of the dot-com crash, right? So,
but it's an interesting point, though. It is, but why is it?
That's
we didn't have inflation in financial crisis time. We didn't have inflation during the pandemic. Nobody's dealt with this type of inflation before and trying to make ends meet. That's why they're all pissed off. I can just see the surveyors calling up people and it's like, hey, Adam, I'm with the University of Michigan. Hey, feeling about the economy. Hey, F you.
Right. Right. But think about this. Like this is happening. Yes, inflation's running really hot right now. Of course, we did have high inflation back at the end of the 70s and the early 80s, which the 70s weren't in the data set I looked at. So I can't say for certain whether this is lower than that or not. But this is still happening with, even though initial jobless claims are coming up for the reasons that we think it should, we're still near record low unemployment, right? So imagine what this would be like in a year from now if prices haven't moderated all that much from where they are right now. Cost of living is still pretty high, but we have to contend with substantial layoffs, right? I mean, that is mind-boggling that we're already starting from this point of already ridiculous lowness. And I think to a certain extent, I was talking about this earlier in an interview that I just recorded with Stephanie Pomboy that'll release next week, is, like, how can we be here when versus some of those other dark times I mentioned? And, Stephanie's mind was sort of like, the consumer has been getting left further and further behind as the story's gone on, right? So, coming out of the 2008 crisis as the markets recovered, right? Well, almost 90% of all financial assets are owned by the top 10% of households, right? So they didn't get to party that much, and they saw the rich people getting a lot richer, right? Pretty much same thing happened on steroids after we had the pandemic hit, right? So it just sort of shows how thin the veneer of everything's okay is truly with the consumer. And now that things are really beginning to get real, right? Now that they're really beginning to have a contend with inflation, and they're not getting any of the perks that the better off classes have been getting, it's revealing how I think I'm going to use the word dangerously unhappy a good chunk of society is here. Right? I think there's a strong sense that, I've kind of been getting screwed by the system, and maybe I was okay with it when, you were giving me checks or there were enough job openings out there that I could get a job if I wanted to. But if that really flips into my house price has gone down, if I have any financial assets, they've gone down a lot. Holy crap, my job's just gone away. And oh my God, food is 20% more expensive at the grocery store this year than last year. I think there's a point at which you lose the confidence of the public. I'm not saying it's going to happen tomorrow, but I'm saying that's the trajectory that we're on here.
Well, look, you bring up a great point, and this is a critical thing when you're reading headlines, and there's a lot of guys that write articles and commentary and stuff out there, and they're trying to put a bullish spin on things, and you'll hear this from the White House as well, as like right now inflation's a Russia problem, but the household's very strong. Consumer spending is great. The household balance sheet is very strong. It's not. And the reason is you brought this up, if you take a look at things like household debt to income ratios, savings ratios for households, the problem with all those ratios is it's looking at the total of the asset, right? So it's looking at total debt versus total income or whatever it is. You've got to strip out that top 10% of income earners because it skews the data so much. And I've done these charts before in the past, but if you look at the bottom 80% of their debt to income ratios, they are not in good shape. They are living paycheck to paycheck. They are barely making ends meet. And that was before all this went on. This was before you had inflation. It's gotten worse now. You get in the top 5% of the population, the top 1% of the population, they've got plenty of excess savings. Inflation really doesn't matter to them very much. Yeah, maybe they'll trim back and they won't buy caviar this month, right? So they'll just, do something else. I'm being a little bit facetious, but you get my point. If you've got lots of disposable cash and income and assets, inflation doesn't really mean a whole lot to you. Maybe you don't fly the private jet twice this week. Maybe it's only once. Those are the decisions they're making at that level, right? But that's not the way average people work. But they're in that ratio of disposable debt to income ratios, savings ratios. Those are the ones that have all the savings, and they're skewing that data. That the real household, and again, look, it's not. Forget that for a moment. Just take a look at some of the statistics we've seen. And Adam, I've talked about this. The average 401k balance is less than 1 year's salary. Only 25% of people in the economy actually contribute to a 401k plan. The average American has less than $500 to meet an emergency. That's the real, and look, if I've only got $500 to meet an emergency, I guarantee you I don't have a healthy balance sheet at home, right? I mean, it just kind of makes sense. So these changes to, and the point about this is these changes to inflation and what's happening with the cost of living is impacting that sentiment. And it's not surprising that with the rise in sentiment, you've seen a corresponding decline in presidential approval ratings. And look, it's not the president's fault that we have these things going on. That's just the guy in the office. He's the one that gets the blame. But again, that's if you're taking a look at sentiment polls, whether it's the University of Michigan Sentiment Index, or you're taking a look at presidential approval ratings, or whatever thing that you're looking at relative to sentiment, they're all in the tank because people, for the first time in a long time, and to your point, Adam, they're upset. They're blaming capitalism, saying capitalism is broken. We need to do something else, and we need to do socialism or communism. No, capitalism isn't broken. We've got problems that we've created in the capitalist system by doing things like bailing out the banks in 2008, doing round after round of quantitative easing and keeping interest rates at zero and not allowing the economy to function and do its Darwinistic job of capitalistic reformation within the economy. Had you allowed recessions to occur, had you allowed these things to happen naturally without interference, the wealth distribution would not be like it is now. You wouldn't have had the market go up from 666 in 2009 to 4,800 earlier this year. We would have been around maybe 2,400, 2,500 on the S&P. Not nearly as fun, but you would have had a much more stable market, a much more stable economy. But we've just done so many things to warp what happens at the upper end of this capitalist system. And we view capitalism through this lens of publicly traded companies and these CEOs, right? We view capitalism as Jeff Bezos and Elon Musk and Jamie Dimon. That's not capitalism. That's warped capitalism. That's corporatism caused by changes to compensation, stock buybacks. We've been through all this before. But, if you take a look at capitalism in America, people going out to start a small business to feed their family, and, and they build an enterprise that creates for them, $250,000 or $300,000 a year of income. That's capitalism working. That's those small businesses we were talking about a minute ago that make up 60, 70% of the economy. That's the backbone of America. That's the backbone of capitalism. That's not the representation of corporatism that we see going on right now. Sorry, got me off on a rant, but there you go.
Yeah, no. So, all right. So I was going to try to segue into asking you about trades you've made this week, just so folks understand all that. But we're going to get that in a bit because you've gotten on a really rich vein here. A couple of things. So first, everything you just said about the consumer balance sheet, I was just talking about this with Stephanie in my earlier interview with her today. You can say about the corporate balance sheet as well. It's the same deal. When they talk about corporate balance sheets being healthy, they are talking on average, right? And it's those massive companies, right? The Microsofts, the Apples, et cetera, that totally distort and skew that, right? So if you actually look at the bottom of 80% of corporate balance sheets, they're actually not doing very well at all either, right? So we kind of have this sort of like Potemkin economy right now, right? Where the veneer looks fine, but if you actually look behind the set pieces, you realize, oh my gosh, this is largely kind of just fake here, right? You also I agree with everything you just said in your rant there about both the importance of capitalism, specifically its Darwinistic cleansing function, and the fact that we really don't have, true capitalism going on right now. And look, we could make a whole interview or a whole series about that. But you talked about, hey, the small business is really the closest that we have here, the small business sector. You talk to a small business person and they'll tell you it's just getting harder and harder and harder to survive, right? So not only do we have this sort of crony capitalism or corporatist capitalism where all the benefits are going to the really big players who are super politically connected and whatnot, but they are then in turn through regulation, through desperate municipalities that are just trying to grab as many fees as they can from anybody who makes a dollar. We are just killing that core engine of capitalism right now. And the reason why all this is so important is kind of at the heart of what I think you were saying there, Lance, which is as people begin to sort of begin to feel like they're drowning financially, right? There's that saying that desperate people act desperately. And you start reaching out to grab anything that you think could save you, even if it's not necessarily a great idea, right? And I think that's one reason why a lot of people are reaching for the allure of democratic socialism right now, especially younger generations, and it's understandable. Look, your prospects are a lot worse off than generations before you. You didn't create this mess, but you're inheriting it, and you kind of feel like you were born behind the eight ball. Hey, maybe you don't like any politician, but you're probably going to like the guy who's going to offer you something while you're getting screwed versus the guy who's going to screw you and not give you anything, right? And the danger here, and this is why I sort of was mentioning when I was talking about the sentiment, I was saying that we're kind of at this dangerous spot where I think the probability of us as a society making bad decisions is really getting higher. And of course, as you said, we're at this state right now where the system has been so deformed for so long that it's kind of beginning to topple under its own unsustainability. It's bad decisions that got us here, but that doesn't necessarily mean we're going to make good decisions to get out of this. We may make desperate decisions as this thing begins to topple, which will make a bad situation even worse. So that's, I don't want to paint the super doom and gloom picture, but like I do kind of spend a fair amount of time thinking about how things may get a lot worse before they get better, both because of the fundamental deterioration, but also the decision making, as bad as it's been, may get a lot worse from here.
Well, and again, it's unfortunate, but there's, if you go back in history, I wrote an article a while back. I mean, I'm probably going to have to do a revival of this article talking about the Tytler cycle, which is a Scottish professor, and he went and examined societies throughout history and kind of the rise and fall and the sequences that they went through over a period of time. And if you go back in history and look, the rise and fall of the Roman Empire, the rise and fall of the Greek Empire, the rise and fall of the British Empire, every empire has ultimately failed. And the reason that they failed is, they started in a cycle where they were very moral and they were all working together. They were all pulling in the same direction, and the society grew and they got wealthier. And then as they got wealthier, then they started, making decisions to be, quote unquote, more lazy, right? And now I can just pay other people to do stuff for me. I can outsource labor. I can do these other things. And so they were outsourcing labor, making other countries richer, making them stronger while they're getting weaker. And they began to take on debt to continue to outsource more labor so they could have, more time, to themselves. They moved away from that moral structure, became more immoral. Of course, you talk about the Roman orgies and these type of things, but that's just a cycle of society. And as the rich get richer and they get, more and more, I guess, bored, for lack of a better term, they keep moving away from what made them strong to begin with. And if you even take a look at America, we're making those same decisions today, right? Where we went from a country where we manufactured everything here back in the 40s, 50s, 60s, because nobody else could manufacture. We'd blown them all up during the war. So we had to rebuild these countries, but we were manufacturing. We were very morally centered, very nuclear, family-oriented economy where we were all working. This is post-World War II. We're all pulling the sleigh together now, and we're building this really strong capitalistic economy. And if you take a look at where we are now, we're now making these decisions that are not economically viable. You and I talked about last week, if you want to have a strong economy, have children. And we're making these decisions that says, okay, these alternative lifestyles are completely fine. You need to support them. You got to be woke and all this. Economically, it's a terrible idea because we already have the lowest birth rate on record. That's going to get worse. I just wrote an article. It's on our website today, talking about the $96 trillion graveyard called Social Security. And the whole problem with Social Security is a very simple process. Right now in Washington, they're talking about adding more people, giving more people access to Social Security. And this is what we've been doing since the 1960s, right? We keep adding more and more and more people to take money out of Social Security, but we don't have anybody paying into it. We had 49 people for every person taking out of it when Social Security started. We're down to 2 contributors to every withdrawer today. And that's just going to continue to get worse because we're not having children. That birth rate in the economy is slowing. And if you don't have taxpayers, Where do you think the money comes from? You can print up debt all day long, but somebody's got to pay for it. And that's the taxpayer. And at some point, if you run out of taxpayers, it's game over. That's it. You don't, that's you done. And this is how you end economies and how you end empires. And we're on that path. Now, this is something that Adam, I mean, I don't want to be doom and gloom like you. And this is nothing that's going to affect you or me or probably even our kids. No, maybe not. You're muted, by the way. But
sorry, I was just saying, don't throw me under the bus as the only doom and gloomer in this conversation.
Yeah. Well, no, I'm just saying this won't affect, these trends, these demographic trends are going to take, 50, 100 years to fully play out, but we're on that trajectory. And it's not going to be us. It's not going to be our kids. It'll probably be our kids' kids, or maybe the next generation after that. But all these decisions that we're making today that are, economically non-efficient, to put it politely, it has serious consequences down the road. China's dealing with it now. That one-child policy has killed them.
Yeah, it created what's called a kite economy or kite demographics. You ideally want a pyramid, right, where you've got a few old people supported by a bunch of young people. They're almost the opposite at this point in time.
As Japan's the same way.
Japan's the same way.
Yeah, 20% of their economy is over 65. So, I mean,
which is a great way to say, look, if anyone's doubting what you're saying, we'll just go look at those economies, particularly the Japanese, and you can get a glimpse into our future, right? If we continue the trajectory that we're on here. Hey, real quick, I just wanted to read that Tytler quote because I've referred to it a lot in the past. I think it's a great and very powerful quote for all the reasons that you just said there, Lance. So let me just pull it up here. Democracy cannot exist as a permanent form of government. It can only exist until the voters discover they can vote themselves largesse out of the public treasure. From that moment on, the majority always votes for the candidate promising the most benefit from the public treasury, with the result that democracy always collapses over a loose fiscal policy, always to be followed by a dictatorship and then a monarchy. I think folks hearing that, whether you agree with it or not, you got to feel a little nervous that a lot of the, signs of deterioration that he ticked off there, you can be like, okay, yep, all right, yep, loose fiscal policy, okay, yep, people wanting more out of the public treasury, okay, yep, right? So, history is very important for all the reasons we mentioned. Those that don't study it are forced to repeat it, all that good stuff. And of course, all this comports with Neil Howe's fourth turning, study of demographic cycles. And folks, if that term is new to you, definitely watch this video here of the interview that I did with Neil Howe, where he goes through the whole framework of the fourth turning. But it's similar to what Tytler said, as well as that more kind of common phrase of, good men create good times create bad men, bad men create bad times, something like that. Where basically because of the prosperity, the next generation to come, kind of takes it for granted. They become profligate, whatever. You get the Roman orgies you were talking about, and then you go in hard times, and then the cycle kind of repeats itself, right? I think it started with bad times create good men create good times, et cetera, right? So,
well, and just to your point though, and that's a great point. England, as an example, went through the Dark Ages, right? And then they came out of that again. And so the good side about this is that ultimately, all this collapses. And then we go, okay, that was a really bad idea. Let's start over. And we go back to our roots and we rebuild and we become strong again. And there is that cycle. So there is a silver lining to all of this. But we can try to avoid that pain. And this is what we're doing with Social Security. We're trying to figure out all these ways to avoid the pain of what's got to happen to fix Social Security. But you can't avoid it. Eventually, somebody's going to have to stand up and go, I'm sorry, we got to fix this. And this is the fix. And I know you're not going to like it, but everybody under the age of 35, you're going to pay into this thing, but you're never going to get a penny out of it. I'm just throwing out, an example. But there's going to have to be paid to fix the problem. But nobody wants to do that because it's not electable. This is why MMT, modern monetary theory, which is neither modern monetary or theory, is so popular, because it's exactly what you just talked about with the cycle, which is people figured out how to vote themselves a paycheck out of government. That's all MMT is. Send money to people, spend money on all this stuff. It's all debt. It doesn't matter. Yeah, it matters. Debt matters because taxpayers have to pay for it. And when taxpayers have to pay for that debt, it extracts capital from their ability to consume in the economy. And 70% of our economy is consumption. It's just math, people.
Well, so MMT, great example, right? It's the modern incarnation of the age-old, voting yourself largesse from the Treasury that Tyler talked about, right? So, I mean, all these things are part of the human cycle. We always think they're new and we're the generation that's living through them, but this has all happened before, right? So you talk about, look, the light at the end of the tunnel in this story is once the unsustainable system corrects, then you get a chance to kind of rebuild better from the ashes, right? I want to bring this back to the main reason why folks are watching this video, and sorry folks that we got away from the market stuff here, but this is all really important because, Lance, you and I have had a little bit of the debate of or the discussion of hey, if we were made emperor for a day, what would we do? And I think we would both say, fine, let's just let natural forces take over. Deflation just craters everything. It gets all the malinvestment out of the system. All the bad debts go bad, right? Insanely painful. No doubt about that. But it should hopefully be swift, violent but swift, right? And then get us to that point where we can say, okay, the correction phase is over. Let's rebuild from a much more sustainable standpoint. Like you said, though, I think most of the status quo is going to do everything in its power to prevent that, certainly the entire political machine, because no politician wants to preside over that, right? So we are going to go kicking and screaming through that process. So how long will it take? I don't know. Maybe we're still going to measure it in decades, right? So it's sadly, we might not get to that better tomorrow, for society soon. But we do have markets that are going through a corrective phase right now. And, within the grand cycle of things, there are lots of little cycles. So the big question right now for most, people who are managing money today is, okay, when is this next correction cycle? How long is this correction cycle likely to take when I can then be positioned to, catch the next up part of it, once the current, biggest malinvestment has been corrected. You and I have talked a bit about bear markets. If this is indeed a bear market, and we're pretty close to it again now, I think the S&P is down a little over 18%, 20% being the official, and I know you don't like that term. But bear markets don't end until everybody is just completely done with investing, right? And we still are nowhere near that stage, correct?
Yeah, it's really interesting. I just wrote an article about this earlier this week. And it's kind of an article. I kind of threw it together. I needed to write something, and I had other stuff going on. I kind of threw this article, and it actually took off and kind of had a really good run with it. But it was called "If Investors Are So Scared, Why Isn't Anybody Selling?" And it's interesting because you look at sentiment, right? You take a look at the American Association of Individual Investors, the Institutional Investor Sentiment Index, the National Association of Investment Managers. They're all very bearish, right? The sentiment's terrible. It's like, I hate this market. It's a bear market. I'm scared to death, but I'm not selling anything. Investor allocations are still near all-time highs. They barely come off despite the decline. And this massive fear in the market, you would have expected that people would be, have 40, 50, 60% cash in portfolios. They don't. They have near record low levels of cash. They have near record low levels of bonds, still very long equity. And it's such a function of the fact that we've taught people over the last decade, oh my God, don't sell, because at any point the Fed's going to come in here and bail you out, and then you're going to miss it and you're not going to be in. So you can't sell. And this is all this passive indexing thing as well. But to your point, I'm still getting way too many emails, and this is a daily thing. I'm getting way too many emails every day saying, Lance, just tell me when the bottom is so I can go buy everything. I've got my whole shopping list ready. We're nowhere near a bear market, because that doesn't happen. As you said, when you get to a real bear market bottom, wherever that is, everybody's gonna be saying, buy stocks? Are you crazy? This is just stupid to buy stocks. And there's a lot of stocks out there that are at that level. But yeah, just sentiment wise, until we see investor allocations come down, I just don't see how we get, we're finished with this bear market just yet. Could be wrong. Look, markets can do anything. And one thing is true, Adam. If the Fed tomorrow came out and said, screw it, we're going to drop rates back to zero and we're going to stop QT and go back to QE, this market's going to take off running. So, that's because the market's now like Pavlov's dogs. All we're doing is waiting for Pavlov to ring the bell. That's it. And, and at that point, markets will perform better. It doesn't mean that, going forward, we're going to continue to have this rip roaring bull market. There's lots of other, issues that markets have. And every cycle of QE is requiring a bigger and bigger cycle of QE in order to get kind of the same rate of return out of the market. So you're getting this efficacy of these programs is becoming less and less each iteration that we do of them. So zero interest rates and 200 billion in QE the next time around. Negative rates and 400 billion after that. No, I don't know what the end game of this is, but if you want to keep pumping these markets up and keeping the cycle going, it's going to take more and more support to make that happen.
Right. Totally true. What's interesting though is, so that's the big question, right? The Fed pivot. When does the Fed come in and does it go absolutely gablonkers in terms of the magnitude, what it's going to do, right? But what's going to prevent the Fed from doing that is persistent hot inflation above 8%, right? And the inflation rate just went up today, as we talked about here, right? So we can't predict what the Fed's going to do with any certainty. We can only guess, right? But the odds of it pivoting near term have just gone down based upon today's data, right? So so if you're waiting for the Fed to come in and ride to the rescue, you just got an indicator today that it's not going to be immediate, right? And you were saying something I think is important here, which is that humans are social animals, right? We're herd based, right? And there's famous studies over centuries, the madness of crowds. People go mad as a crowd and insane one at a time, or something like that. I'm murdering the quote, but our behavior tends to be influenced by those around us, right? And so sentiment really matters because that's what the herd is thinking at any given time. And if you look at a herd, if a herd starts getting nervous, it's not one cow leaves and then two cow leaves and then four cow leaves and it's a dribble. It's the herd starts getting nervous. They crunch a little bit closer together. Maybe a cow thought it saw a predator out there, but they get more and more nervous, but they don't go anywhere. Right? And the nervousness builds and builds and builds and builds, but the herd doesn't move. And then it gets to a point where one cow bolts and then they all go, right? And, essentially what I hear you saying is the herd is not at that stage yet. The herd has not moved. And so, yes, we could have one of these face ripper bear market rallies that you and I have been warning people about, but there is potentially a growing risk here as we continue to see, weeks in the market like we just had this week, where if the herd gets spooked, like if you think down 18% in the S&P so far this year is bad, we could go down another 10% like that if and when we get to that trigger point where sentiment shifts from positive, net bullish to net bearish, right?
And that actually applies to a couple of other things as well. Inflation is that way. If you take a look at historical rates of inflation, go back to 1960 and run a chart of CPI. What happens with CPI is CPI doesn't spike up. And again, there's been plenty of periods throughout history where we've had inflation spike up. And sometimes it went from, 1% spiked up to 3% pretty quick or whatever. But it doesn't go up and then just kind of trend sideways for a while and then start to kind of dribble off. It's up and it's down very quickly because spiky. It's very spiky. And the other side of that is that also energy prices are exactly the same way. Energy prices spike up, and then when they break, they come down very sharply. And the reason for that, for both of those, is because of that same herd mentality. When the consumer finally gets broken by inflation, they stop. You have a recession and inflation comes down because they stop spending, and you have this immediate contraction of consumption. Oil prices are all driven by commodity traders. So, oil prices are somewhat supply and demand driven, but a lot of it is these non-commercial speculators in the options markets that are driving oil prices through options contracts. And so and right now, everybody's ramping up their oil contracts. You take a look at, at futures on contracts, everybody's being long oil, right? The oil's going to 300, whatever it is. Well, at some point, somebody says, I'm out. And when that guy goes out, whoever that guy is, he's like the popular guy that brings all the people to a party.
Yeah.
Whoever that guy is, when he says, I'm out, the rest of the herd follows him. And that's why oil prices don't dribble down. They go straight down. And this is why we keep talking about take some profits out of energy stocks, because you'll wake up one morning and be down 20% before you know it.
All right. So great point. I just want to share something really interesting with you. So I think I mentioned I interviewed Art Berman, who's an oil expert. That interview is coming out early next week. So Art, and you'll see in the video, he goes through just an unbelievable amount of data to explain what's going on with oil prices. So he's very, very empirical guy, engineer, petroleum engineer, very data-driven analyst. When we finished recording the video and we were just chatting afterwards, he was telling me that he's been reading Carl Jung recently, because he said in his 40 years of experience in the oil industry, psychology had the greatest explanatory value in terms of what was happening with prices. He said, I can track the fundamentals all day long, but if I'm really being honest, it's human psychology that explains way more of what's going on with prices than all the fundamentals do. So
Yep.
very
No,
much exactly what you're saying.
it is. And we have to remember that about markets and how they work, because it is about psychology. It is about the herd. The market is a market, and it is buyers. It's a big wad of buyers over here and a big wad of sellers over here. And those sellers are selling stuff at buyers, and buyers are going, yeah, I'll buy it at this price. And sellers are going, okay, if you'll buy it at that price, will you buy it at this price? And they say, yeah, I'll buy it here. So prices go up. Same thing happens in reverse. When the sellers outweigh the buyers, that's why prices decline, because sellers are going, hey, I'm out. And buyers are going, hey, I'm down here. I'll buy it here. And so prices come down, just like you saw today. Prices came down and buyers started kind of buying about 10 o'clock this morning, and kind of prices stabilized, for the bottom of the day. But we kind of just hung around those lows kind of all day long today. There was some buyers sitting there willing to take stocks off of weak players today.
All right. Well, look, let's toss the viewers a stake here. So, let's get to the market action just real quick, because I do have two other quick topics I want to ask you before we wrap up. But definitely not, if you're long, not a great week for the markets. The past 2 days have been not fun at all, I imagine. So can you give just a quick recap of what you think drove the market this week, as well as any trades that you guys may have made?
Sure. So really, so every day on our website, we put out both daily commentary on our website, which has a market trading chart in it. And we also produce a 3-minute video every day talking about basically what's going on in the market and what we're doing. So, all week long, the message was pretty much the same. Is like, we're trapped within this very defined trading range. The market was just running up to the top of where we were last week. And then we come down and test the lows from last week. And so it was this very tight trading range we were just bouncing around in. Well, at the same time we were bouncing around in that trading range, the downtrend line from earlier this year was encroaching at the top of that trading range and was starting to push it down. And so our concern was that we said, look, if this thing breaks to the downside, which is becoming a more likely probability, that's going to have a very sharp decline fairly quickly, because everybody's been hovering in this little trading range, hoping for this rally to kind of extend itself a bit. Well, we broke to the bottom of that. And as soon as we broke, it was like somebody opened a floodgate and everybody ran out. So, we were concerned about that. So earlier this week, we raised some more cash. We added a short S&P 500 ETF to our portfolio, because we were worried about this break to the downside. And so that occurred. So, we've got a little bit more kind of coverage here. And I think that Monday or Tuesday wouldn't be surprising to see this market bounce a bit, only because you wiped out a bunch of gains in like 2 days, and we're coming back to retest those lows from May. And I think you can see a little bounce here. But any bounce you get, if we get a day where we're up 1 or 2% in the markets, I would sell that bounce and add to a short, because I think at this point now we're going to start working our way a little bit lower here over the next, potentially month or so.
Okay. And I do want to give you credit that for 2 months or so now, or at least a little over a month, you've been saying, hey, now that we're seeing this bounce, this is a rally to sell into. And it seems like that's proving to have been the right call here. Sounds like if it's offering similar advice, if indeed we get another bounce next week.
Yep.
So I've also read that June options expiry is next week, next Friday, and that we talked last month because there was a pretty abnormally large one. I've been reading that this one coming up is even bigger. Is that impacting any of what's going on right now, do you think, or is it separate?
I don't think. Well, some of it could be. So every month we have options expire. This one's coming up is $3.2 trillion. I think when we had back in February or March, I can't remember now, was 3.8. Those are the two largest I can remember seeing anytime recently in trading history. I mean, we've had some large ones before, but these are really big. And that's because all these retail traders and everybody else have all been trading options and buying put options on markets and all this. The problem is that so if I'm the one, making the contracts, I'm making the options so that you can buy it. Well, if I'm, creating a put option or a call option, I've got to buy or sell that underlying stock on that option. So as the market maker, somebody's got to reposition going into next Friday as that option expires. They either have to sell or buy to rewrite contracts for the next site for the next month going out until the next option. So what, and where we're currently positioned, there's one guarantee that's likely to happen by next Friday is a lot of volatility next week. I would not be surprised to see this market jump around a good bit next week. We've also got the Fed on Wednesday. They'll be hiking 50 basis points. There is a rising potential. They could do 75 basis points. Personally, I don't think they will. I don't think they want to spook the markets right now. I think they want to try to get off a 50 basis point hike this time, and then, two more probably by September, and try to get that rate up to 2.25 at least on the Fed funds rate. So they have some room to operate if we do get into a recession. They're not stupid. They know a recession's coming. So I think they want to be positioned for that. So I don't think they want to do anything to spook the market. So I think they'll do 50, my guess, I could be wrong. But because of that, and then, if they come out and they're potentially a little bit dovish in their stance, whatever, maybe we get a little market rally, Wednesday, Thursday. But Friday, you could see a lot of volatility. Like it could be one of those markets where we open down in the morning and finish up in the afternoon, or open up in the morning and then get wiped out late afternoon. You never know how these options expiration are going to play out. So it's better to not try to guess it. I'd go into that with a little bit more cash and maybe a bit of a hedge.
Okay. All right, great. All right. Well, look, we got to start wrapping things up here. Lance, there's two things I'd like to ask you about. We don't have time, I think, to do one of them true justice, but I do want to let you say whatever you want to say about it at a high level. Maybe we make a deeper dive in next week's video. But that's some new decisions coming out of the SEC that are going to impact the way in which our markets function, and maybe actually kind of clean them up a little bit.
Yeah. Just two things real quick on that. And yeah, let's save this for next week because this is a 30-minute rant all by itself. Yeah. Gary Gensler, who is the chairman of the SEC, came out this week, and in a nutshell, he's directed the SEC to start figuring out ways to make the market more fair. Good job. Needs to have been done for a long time. But one thing he's talking about in particular is moving the market to an auction-based market. So orders would go into an auction pool, and then everybody would bid on the execution of the order. That's awesome, right? Because what that does is that provides the best bid and offer to the investor. So you get the best price. What it kills is payment for order flow, which means the value of Robinhood is exactly zero if that rule goes through, because any company that survives on payment for order flow, they're going to be out of business. And then very interesting sideline to this is that in 2004, a lawyer wrote a letter to the SEC saying that payment for order flow is a predatory practice on investors and should be banned. That was in 2004. So now they're talking about it in 2022. And the largest player in payment for order flow is Citadel Securities, who paid Robinhood $100 million, I think in 2020 or 2021 for the orders that they got. Now, if Citadel is willing to pay Robinhood $100 million, that means Citadel's making money on those trades, which means that free isn't free. You're just paying for it in a different form by getting worse execution. But the interesting thing about it is that lawyer that wrote the letter to the SEC in 2004 suggesting that the SEC ban payment for order flow was the lawyer for Citadel Securities. Just to let you know. So again, I think this is a great conversation. I'm actually writing an article on this. I'll have it up maybe by next week as well. I'm not sure where it's in my stack of stuff I've been writing lately to get out because there's so much stuff going on. But definitely next week, let's talk more in depth about it because it means a lot for retail investors, and it would be great if it happened because it would level the playing field for the average investor. It will never happen because Chairman Gary Gensler for the SEC is a political appointee, and the people that write the checks to keep people in political power mostly come from Wall Street. So
right, we'll get him yanked. Yeah, and I've been talking with markets expert in the plumbing of how our markets work, Joe Saluzzi from Themis Trading, who's actually gone and testified in front of Congress on a lot of these things. And it's a really fascinating world. If you ever read the book Flash Boys by Michael Lewis, you have a sense of the intrigue and the incredibly hugely financed arms race that's going on Wall Street in this invisible world you don't understand where things happen in milliseconds. But there's a ton of money being made by the entrenched players like Citadel in this space right now. So the point is let's all hope for the wheels of justice to do the right things here. But you already showed how slowly they've been moving on this topic already. We should probably expect it to continue to move slowly. But anyways, when you get that piece written, Lance, let's have you come on and really delve deeply into that because it really could be a rare and very important positive move if it actually gets implemented. All right, so the other topic I want to talk to you about, I think we'll probably save this one to go deeper into at another time too, but I wanted just to get a little bit of a fun rant on with you. Did you see the article this week about Geico losing a lawsuit because a woman had sex in a car and caught an STD from the man that she had sex with in the car and was basically able to sue the car insurance, the auto insurer, for the damages that she received from getting the disease, right?
Well, this is why we have, disclaimers on hair dryers that says do not use in the shower and, warnings on coffee cups that says hot liquid inside, because people file these ridiculous lawsuits. And so it requires future disclaimers that says, by the way, your insurance on your automobile does not cover sexually transmitted diseases.
Yeah. So what's crazy about, yes, you're right. This is why we can't have nice things as a public, right? And what struck me on this is this opens a crazy door, which is like anybody who feels aggrieved about anything that has ever happened to them can sue the homeowner's insurance, can sue the commercial property insurance, can sue the auto insurance. For anything, right? Oh, you said something to me that mentally damaged me. It was a microaggression that then caused me to not want to go forth and pursue my potential, and therefore my losses from not doing that are 50 million, and you owe me, right? So it is interesting to me that a big insurer like Geico just lost this case. Now, will this thing get thrown out? Will the outcome just be another rider in your auto insurance? Who knows? But where I'm going with this is that even big players like Geico, right? It's a Warren Buffett portfolio company. It's a massive company. It still lost this case. It's having to pay like $6 million to this woman. And it underscores the fact that just, we live our lives, and we should live our lives not worrying about every single step we take. But there is a risk out there of sort of frivolous lawsuits, or not even frivolous lawsuits, an unexpected lawsuit, whether it be frivolous or due to an accident that you just, you had because it was an accident. And I know that, Lance, you're in the space of dealing with people who all of a sudden get hit out of nowhere with a lawsuit and the impact that it has on their wealth. I'm a big fan of umbrella insurance. I don't necessarily think we've got time to kind of go into that yet, but I think that's one of the best values out there right now that gives a fair amount of protection to some of this stuff that most regular people don't even understand. They don't understand what it is, and they don't understand how cheap it is. But anyways, without going into the details there, is there anything you want to say about this topic as we earmark it to go deeper on a later date?
No, there's definitely, and it goes to show you two things. One is that what's wrong with what's wrong with the judges, and this is, really disappointed in a lot of things I've been hearing come out of judges as of late. They have no backbone. And again, if I'm the judge on this case, I'm like, get the hell out of
Yeah.
quit taking up my time and taxpayer money with this stupid case. This is frivolous. Get out of here. About 5 years ago in Texas, we used to have the ability in Texas to basically rebut a claim that was frivolous with a countersuit to sue for a frivolous claim. So if you made a frivolous claim against me, I could sue you back for making a frivolous claim.
They call this the Johnny Depp approach now, but go ahead.
Pretty much, yeah. But they've thrown that out in Texas, and that got overturned about 5 years ago. So now I can sue you for anything. I can just make crap up and sue you, and then you've got to go through all the legal expense and everything else. And this is why I'm a huge fan of umbrella insurance. Me personally, I'm in a sue happy business because I'm in the financial advisory business. People can sue you for anything. So I have money and annuity. They're judgment proof. They are, provide tax deferred growth, but they are basically, shield assets against judgments and against lawsuits if one of those occurs. So if you're in a high risk business, we've talked about this before, there's things you can do to protect money. Whole life insurance policies that grow tax free, have tax free withdrawals, they're judgment proof. Annuities, if they're structured right, judgment proof. Setting up a trust, separating your assets. If you have a bunch of rental houses, those should all be in separate LLCs and not in your name. Somebody walks out to the house, they like the house, it's like, oh, pretty house, and they fall off the front steps and they crack an ankle, then they sue you, right? And the next thing you know, you've lost your house. So, those things happen. It's like, oh, that happens to other people. No, it happens all the time. And, it's very simple things that you can do to shield yourself against lawsuits and judgments and bankruptcies and these type of things. But you just need to go through the process of thinking about it, preparing it. And we can certainly spend, an entire show, going over this type of stuff.
I mean, I would kind of like to, because I think, a big part of what we're doing right now, right, is we're warning people about the macro risks that are coming and trying to get them to take prudent steps beforehand. Yeah. I think we talk about a lot of like hedges, we refer to them as the type of insurance and whatnot. I think insurance is also just something that people need to probably do an audit right now and say, do I have enough protection, against my wealth right now? So we'll do this. We'll put it to a poll here, folks. If you're watching and you'd like to see us do this, let us know in the comments section below. If there is more interest, or enough interest, that Lance and I will dive more deeply into this going forward. Yeah. Just in case we don't, I do want to just share one little tidbit. And I said, I'm a big fan of umbrella insurance. Even if you don't know what it is, folks, just remember this one thing. They say that the time in life where it's most important to have it is when you have a teen driver in the household. And I say this as my 15-year-old got her permit right now and we're working towards getting her license when she turns 16 in a couple of months. Yep. I'm sure there's a number. Yeah, sure. There's a number of parents watching this. It's for no other reason, go research umbrella insurance for that reason alone. All right, Lance. Well, look, we made it to the end of another great week. Folks, if you enjoy this conversation, you'll like these weekly market recaps that Lance and I do, please do me a favor, support this channel by hitting the like button if you haven't already, and then clicking on the red subscribe button, as well as that little bell icon right next to it. If you don't already know this, we highly recommend, given all the storm clouds of the perfect storm that Lance and I were talking about, recommend that you work with a professional financial advisor to develop a plan for how you're going to manage your portfolio for what's coming ahead. If you have a good advisor to do that with, great, stick with them. But if you don't, or if you'd like a second opinion from a knowledgeable advisor like Lance, even Lance specifically, you can go request one for free. Don't cost you anything. There's no strings attached. There's no commitment to work with these guys. They'll just sit down and talk with you as a public service. Go to Wealthion.com and schedule one of those initial consultations. Lance, with that being said, things are getting really interesting right now. Whatever the markets do between now and next Friday, you and I will be recapping it here next week.
You got it. See you then.
All right. Thanks for watching, everybody.